and because he's the one producing, it sees the tractor as it's my tractor, and he begin to use it, and he may not be able to, in a way, calculate the wear and tears of the use of the tractor for that particular period of time as part of the production cost of that at that period. In that case, that tractor that has been used can be referred to as the implicit cost, because the producer will have seen the use of that particular tractor as nothing that he could just add to the production cost of production. Whereas, had it been the producer went ahead to purchase or to rent or hire that kind of tractor, he will not get such for free, but you have to pay for such. And when he's paying for such, it will be obvious to him, and he will be conscious of adding such rent as part of the production cost. But in a way that he is using his own personal one, he may not be able to add it to the cost of production. Those are the types of costs that we have, and we are now categorizing cost into some other category, in a way to get the extent of the cost and how much of the cost we've incurred over a period of time. And those categories are what we refer to as total cost, average cost, and marginal cost. These are the costs that we are calculating in the process of production to know the total amount of cost, or the total per head, or how the cost is being incurred. The total cost is just the sum of the total fixed and variable costs, which are given explicitly. We can also refer to them as the addition of total fixed cost and total variable cost. Another name that we can give to the total cost is what we refer to the other time as part of the types of cost as explicit cost, because it combines both the total fixed cost and total variable cost. We can see the calculation of the total cost like as the total fixed cost plus total variable cost. That is the total cost. When after a certain period of production and we want to determine our total cost, so that we know how much we've incurred over that production process, then we need to calculate how much of the fixed cost have we incurred plus how much of the variable costs we've incurred. The accumulation, the combination of the two will give us the actual value for the total cost. The other category of cost is what we refer to as average cost. Average cost is simply refers to the ratio of the total cost per the unit and per the total output. The average cost is the cost per unit of output. That is, after the production, we have certain outputs that we produce, product that we produce, it refers to as output. We want to see how much have we produced and how much cost we've incurred over a unit of the output. If, for example, we produce 20 or 30 or 100 units of a certain product, then we'll now calculate what is our total cost. If total cost is, for example, 100 naira and the total unit of output is 20 naira, we want to know how much of the cost we've incurred on a unit, just one unit of the output. Then we'll divide the total cost by the number of outputs. Then by dividing 100, which is, for example, used as our total cost, by the total output, which is 20, then we'll discover that we've spent 5 naira over a unit of output, and that is referred to as our average cost. And the last category that we have to look at is what we refer to as marginal cost. Marginal cost is defined as increase in the total cost due to increase in one extra unit of output. If at the end of the production process we produce 20 units of output, and we want to add more, we want to produce more. The additional output that we are producing, by trying to get the how much cost we incurred on such additional products that we are producing, is what we are referring to as marginal cost. Marginal cost is simply the additional expenditure, the additional cost over an additional unit of output produced. Therefore, marginal cost can be defined as increase in the total cost due to increase in one extra unit of output. If the producer wants to increase output, then he has to engage extra unit of labor or extra unit of capital. Then the extra unit of capital, the extra unit of labor will lead to extra expenditure on wages paid to such a labor that's just being employed. As a result, the total cost of production will increase. Therefore, there will be an increase in the total cost, and that increase, the margin between the previous total cost and the new total cost, is what we refer to as marginal cost. That is, those are the categories of cost that we have. Revenue. Revenue is another very important concept in economics. The study of cost is not complete if we do not talk about revenue. Then, what is revenue? Revenue is defined as the amount a person receives by selling a certain quantity of the commodity. You know that a commodity can be purchased in the market by paying a certain price. So revenue can be calculated by multiplying the price and quantity of the commodity. Hence, we can write revenue as the price of the commodity multiplied by the quantity of the commodity. Or simply with the sign R, which represents revenue, is equal to P, which represents price of the commodity, multiplied by Q, which represents the quantity of the commodity. During a given period of time, the seller sells a certain quantity of the commodity. So the total amount of the money received by the seller during that period is called total revenue. We denote total revenue as TR, and we denote price as P, and we denote quantity as Q. Therefore, total revenue will be equal to price multiplied by quantity, or TR will be equal to P multiplied by Q. That is the formula we use for total revenue. Another term used for total revenue is called total sales proceeds. Because revenue is received by selling a commodity, it is also called total sales proceeds from that commodity. That is total revenue. Now, average revenue. Average revenue is also denoted as AR. It is calculated from the total revenue. That is, we can get average revenue calculation from total revenue. That is, the formula for average revenue is given as AR equal to TR divided by Q, where AR is represents average revenue, and TR represents total revenue, while Q represents the quantity. Takes for the case of a single commodity, we know that TR is equal to P multiplied by Q. That is, total revenue is equal to price multiplied by quantity. Then AR will be equal to P multiplied by Q divided by Q, which will give us P, because Q up will nullify the Q down. Then average revenue and price will be the same. That means at the end of the day, you discover that average revenue and price will be the same value. Therefore, they are written together, or sometimes they are used to represent each other. Then marginal revenue. Marginal revenue is defined as increase in total revenue due to 1 unit increase in the sales of that quantity of output. That is, any addition in the sales of that quantity is what we are referring to as marginal revenue. For example, if 1 kilogram of guava is sold for 50 naira and the vendor sold 20 kilogram of guava in 2 days, the average revenue of that particular sales for that period of time will be the multiplication of the total sales by the price, which means 20 multiplied by 50, which will give us 1,000 naira. That is 20 kilogram of guava that is being sold for that period of time is equal to 1,000 naira, and the quantity of the guava that was sold was 20 kilogram. Therefore, to get our average revenue is by dividing the total revenue by the quantity, which is 1,000 divided by 20, which will give us 50. And that is to prove the calculation of equating average revenue with the price as we did the other time. That is 50 naira for the 1 kilogram of guava, which equates average revenue and the price to be of the same. Another example, which is example 2, is to have if the vendor could sell 21